Hello, YouTube. My name is Justin, and this weekend we're going to try to answer the question as to whether or not there is more downside because Jerome Powell is going to be speaking on Tuesday. And after a big surprise on the Federal Reserve's meeting minutes that came out on Wednesday, there is a big chance we could be headed for a continuation to the downside. This video took me a lot of time to do this weekend because I recorded about a 1 hour video and the audio did not work. I've been up since 5 a.m., currently 2:30 p.m., and I've been at this all day to get this video out. So what I would really ask in return is that you could smash a thumbs up, and drop me a comment to show me some support. I would really appreciate it. And the last video was 55 minutes. This one might be around that same time. If it is, great. If I get it down shorter, great. I'm going to leave this one as long as it needs to be because I want to use it as a frame of reference and a point of us being able to return to try to understand the context of where we could be as we look back in a few weeks and in a few months. I hope I am wrong about this. I'm going to go through and bring up a couple things here just to try to craft the narrative, and then we're going to go through and tell the story. So the first one here is I just had a gut feeling something was wrong this week, and I'm actually almost all back to cash. I'm at less than like 20% invested right now, and it feels great. I always get a lot more insight when I go through and do these weekend deep dives, and this weekend especially, I feel like I am very prepared. And when I look at the data coming out, good, audio is working. I can move forward. There is so much data this week. It is jam packed. All right, let's start reading here and get the show underway. Whatever the fundamental and macro considerations, there is no doubt that investors have been selling first and trying to figure out the rest later. At no other point since the bursting of the dot-com bubble have so many companies fallen like this while the index itself is so close to a peak. So if we think about what I said about the S&P about a couple weeks ago was that on the surface, it looks cool, it looks healthy, it looks nice, it looks calm. When we kick the tires, when we lift the hood up, it doesn't look so nice. And over here, what this is pointing out is that the Nasdaq, but the number of stocks hitting a fresh 52-week low is at 50%. And this looks very reminiscent of what happened in 2000. 2000 was a terrible time for stocks, if you don't remember. And we will review it a little bit later, but there was about $18 billion in inflows into ETFs this week. However, QQQ actually saw outflows. What does that mean? Money flowed in, but tech saw money flowing out. This is from Larry Summers, who was the former Treasury Secretary between 1999 and 2001 during the thing we just talked about. His view here is that my own view is that the Fed and the markets are still not recognizing what's likely to be necessary. The market judgment and the Fed's judgment is that you can somehow contain this inflation without rates ever rising above 2.5% in terms of the Fed funds rate. What does that mean? It means that he thinks they're wrong, and he used to be the guy in charge of printing the money during the dot-com boom and bust. Let's read one more headline here, and then we'll go forward. If inflation did come down without the Fed hiking its target rate past 2.5%, that would only be likely the economy had proven unable to cope with tightening of lesser scale. What does that mean? The market might be weak. You might not be able to handle the rates. It may be, as some argue, that because of greater levels of debt, because of asset prices are sustainably high inflated, the economy is more vulnerable than usual to rate increases or to quantitative tightening. Friday's job report was strong. There is no path towards more moderate price increases without a cooler labor market. Larry Summers interpreted the Fed as having a very real and even likely possibility of kicking off its rate hikes in March. So that is very, very important. And what I want to do now is actually just go up to the top here and go through these things one by one. So before I dived in, I saw a lot of economic data. Actually, what I want to do first, since I'm re-recording this, is actually jump forward to a different section because I think what I want to do is actually frame this in a way where we can try to understand a little bit better. So for me, I think that we are hitting peak credit cycle. And what I would normally see to have that would be a few things like the riskiest assets selling off first. So I personally think with it, peak crypto, peak Arkk, and peak credit cycle. I'm going to focus on two things, and then we're going to move forward. And again, if you're enjoying the stream, I would really appreciate you clicking on that button to make the thumb turn blue and show Justin a little bit of support. All right. Let's go forward here. So peak Arkk. Let's go through this one first, just because it's the easiest story to tell. And again, I don't particularly like saying that these things are going to go down because I know that the crowd is long. And if I'm wrong, I'm going to look pretty stupid. I don't care if I look dumb. I think the warning sign is relevant. So a very good preview for what the market is also telling me, because as we look at the next section or the credit cycle, everything is flashing a warning. I'm not talking one sector. I'm talking every one. In every single thing that I would expect to see if we were tightening monetary policy and when we were going to take a leg lower is currently unfolding. So you're probably familiar with this chart by now if you've been following this channel. This is the psychology chart. So I'm just going to go to this view for a quick second so you can see where the launch pad starts. So we got this launch pad over here on the bottom left-hand side, right over here. And then so the first part here is that we take the rocket ship up. We go from our launch pad here, whoop, we go all the way up to Mars. We're singing Kumbaya. We got doggy coins, right? Tesla to the moon, to infinity and beyond. And then we put in a head and shoulders pattern, right? Peak out right here, start to dribble out on the right-hand side. Then we fall down, form a first head and shoulders, second head and shoulders, and then the massive neckline right here, which is where we currently are. We also do 3 low connects, and then we get an area where we meet the most important red line right here, and where we fall. That's where I think that right there is, what part is that one there? That is denials. I'm a little bit in denial. I don't want to believe this, but the warning signs are becoming more and more obvious, and it is hard for me to not see this pattern as I go through it. So looking at this right here, now we're going to move forward to the Arkk chart. There's your launch pad. There's the top. There's your purple head and shoulders. There's the dribbling out on the right-hand side. There's your first low, second low, third low. They all connect. And then we form that right part over here with the previous red line right here. So red line, the downtrend connects it. We got 3 lows. We got our high right here. First, second, third dead cat bounce, rejecting off the relative high. That looks almost identical to what we have here. So 3 lows. So launch pad up. High right there, and the shoulder on the side, high right there, shoulder on the side, just a little bit more extended, pushing off the 50, almost all the way back down to the 200. Looks very identical. And this area right here is where the selling starts to accelerate dramatically. Big cut, dead cat bounce, nasty cut. Then we're all the way back to where the launch pad was. All right. So again, I'm not thrilled, but it's hard not to see it once you see the lines drawn and you compare it to the psychology chart. So where is support if it does repeat? It would be at the previous launch pad, and capitulation / anger aligns with roughly 45 to 60. So what does that mean? Basically, all the way back to roughly the launch pad. Second thing I want to note here is just that it's not just the technicals that are telling me that the pattern is too clear to ignore. I also see this in terms of the narrative being crafted out there. Sorry, Jerome, I don't want to put you in that camp. You're not with Cathie. But anyways, what I'm noticing here when we look at the next chart, all right, so if we're at this part of the cycle, which is where we're forming that neckline, what does this say right here? Denial. My investments are with great companies. They will come back. Okay. Is that what Cathie's saying lately? Let's have a look here. There's Cathie, right? Telling us to just easy. Our stock's on deep value. This is from December 18th. So December 18th, Cathie Wood says innovation stocks are in deep value territory. One more time. Cathie Wood says innovation stocks are in deep value territory. Let's read this again one more time and just see if it makes sense. Denial. My investments are with great companies. They will come back. I have a great portfolio. They're in deep value. They will come back. Isn't that kind of the same thing being told here? Kind of is. Okay. Now, let's read one excerpt here from the article as well. According to our current estimates, our today could deliver a 4% compound annual growth rate of return during the next 5 years. So the important thing here is the percent gain, the CAGR or compounded annual growth rate, and the 5-year time horizon. What is she saying? Hold on tight for 5 years. Don't sell. Only one other time in Ark's history at the end of 2018, there's that 2018, has the 5-year return projection been that high. Oh, God. Do you see what I see? If you do, smash a thumbs up, drop me a comment, tell me why I'm wrong, because hopefully I am. Peak crypto here, but I'll talk about one more thing. Let's just go through it. Let's just do this really fast here. There's actually lots to go through, so I'm not going to do all of it. Let me just jump down to one or two parts. Right here from Goldman Sachs, and they have never done anything wrong to the average consumer. Like 11 years later, they're still fighting for the 2008. Who caused it? Cathie Woods just said about 40% CAGR over the next 5 years. What are now people talking about with the Goldman and Bitcoin? Everyone's saying Goldman said 100K. Well, how are we going to get there? If Bitcoin's share of the stored of value market were hypothetically to rise to 50% over the next 5 years, there's that 5 years, its price would increase to just over 100,000 for a compounded annual return or CAGR of 17 to 18%, said Zach Pandil, co-head of Global FX and EM Strategy, wrote in a note on Tuesday. And this has been getting recycled. Hypothetically, hold on for 5 years and you might make 50%. That sounds great, doesn't it? Yeah, it sounds fantastic. I'm not going to go further than that. All of the same things are setting up here on crypto that I see with the others. And right, there's your head and shoulders, knees and toes. What do we got right here? Head and shoulders, knees and toes. And as of right now, we are below. Again, I'm recording this as of Saturday midday, and we were sitting here at about 41.4, the previous top. We fell below it. I don't know where we currently are right now, but usually when a level gets breached, it usually at least retests it. So that is crypto, just really fast. And then what I want to go through here, cycle, because peak cycle for me basically means are there any other things out there that also signal what I am talking about? So we'll get to the other articles here in a moment. But the first thing here is just the Tina argument. There is no alternative. I've been saying it myself. It looked like there was no alternative. Now it looks like there is. So with surging interest rates threatening to dent equities, there is no alternative argument. So what I'm going to talk about here for the next couple of slides, then we'll go back to our normal regular scheduled show, is beta. So what is beta? So I'm just going to read this here and hopefully it'll make sense to you. Higher beta to the upside should also see higher downside. What does that mean? When we're going up, what goes up faster will go down faster in a downturn. So if what normally goes higher when we're going up is now going down faster, for me, that is evidence we're in a downturn. Okay, so ES versus NQ. NQ is higher beta than ES. What do we note here? It's down almost 3 times as much. There's a lot more beta. Looking here at BTC versus ES. Again, I shot this earlier in the day. BTC was a little bit green. ETH was red. Same pattern we've been seeing. ETH is lagging or underperforming. It has more beta because we're going down. TNX versus TLT, 10-year versus 20-year, 10 years up, 20 years down. Okay, cool. Also agrees. Crypto versus gold, also agrees. Okay, QQQ versus Arkk, also agrees. Even with Ark's big decline going below 100, currently sitting at 84, it still has more juice to the downside than QQQ. Why? It's down by more, 1%, 1.3%. So this is going to be what's explaining this here. So the differential, a version of some model that is the subject of significant analytic controversy, at least gives a back of the envelope glimpse into shifting valuations in two markets whose relationship defy easy quantification. Put simply, the more bonds sell off, the higher their payouts become relative to the cash flow generated by big tech companies. Again, this could potentially complicate things for dip buying reflex that has defined equity markets for more than a decade. 10 years. What does that mean? If habits are formed in 30 days, what is going to happen 10 years later? Aren't you like, screw it, just buy the dip. There's a dip, just buy it. Yeah. There is no alternative. You got to buy the dip. Placed exorbitant multiples on growth stocks because there was no alternative. Seemingly overnight, it is becoming too apparent as if there will be ample alternatives by year end. It will be hard to identify. There's a part here that's cut off. I'm just going to read it. It will be hard to identify at which levels high growth names will stabilize in an environment where the Fed is raising rates and shrinking its balance sheet. The alternatives that are re-emerging provide a greater degree of stability. Again. So as we go further here, what it's basically talking about is dwindling premium. Nasdaq 100 earnings yields fall to lowest level relative to bonds. So here we got the 10-year note, which is the blue line. We got the red line here is the Nasdaq. What does that mean? They're starting to meet. As that starts to meet, the benefit of holding onto tech stocks is not nearly as attractive as it's been for the last couple of years, up to the last decade. Put it simply, as the result, the Nasdaq 100 earning yield, a measure of profits relative to share price, has been whittled down to 0.85 percentage points above the 10-year note, and we're expecting major rate hikes through 2023 by 2%. What does that mean? It's going to move. There's not going to be a differential anymore. The smallest advantage seen since October of 2018. There's that stupid 2018 again. Jeez, right? Why? Look what happened in December of 2018. 10% down. So October, November, December, 2 months after October of 2018, boom, 10% down in 1 month. Oh, crap. 2 months from now is what? It's March, when we think we might have a live meeting. Oh, crap. Yep. Oh, crap. While all this has been churning, there are signs that ever-present dip buyers attempted to unsuccessfully catch the fall. Nearly 18 billion is flooded into ETFs over the past week, meaning year to date. But QQQ, which is currently worth 208 billion, actually saw outflows, shedding nearly $700 million. So what are people doing? They're selling first, asking questions later. And then finally here, the question looming on investors' minds is, can tech earnings weather further rate shocks should the 10-year yield rise to 2%, as many now predict? Nasdaq 100 firms would need to climb 9% for the benchmark price to stay where it is and maintain its current valuation. For us to go flat during earnings season collectively, we have to see growth of about 9% for us to go flat. More than 9 would mean we can grow. That might be a high hurdle to clear. Analysts expect software and internet companies to report a 5.9% increase in 2022 profits. What does that mean? We're only 65% of what we need to go flat. So if the bar is high and we're likely not going to meet it, we're probably going to go down. This also matters because Apple is going to be the I think it's going to be the 27, which would be month. So what would that be? After all this is unfolding, we could easily see a new leg lower into February just based on this, where the expectations fall short of what is needed for that relationship between bonds and high growth tech names to be successful. And this is where the $18 billion flowed this week. We can clearly see it here, right? Went into financials, went into telecommunications, went into aerospace and defense, went into farm and agriculture, went into energy. Boring names. $700 million in outflow saw the biggest weekly decline for Google and for Microsoft going all the way back to the lockdown. Oh, crap. I think that's all I'm going to go through here. So I'm going to go back now to my normal thread. So for me, that looks like a peak credit cycle. Now let's go through to the rest of our story. It's about 19 minutes in. I'm going to start going a little bit faster. Let me just make sure I got the right thread here. Calendar of events. All right, me scare. It's not the video I want to record, but this is what I'm seeing. And here we go. So on Tuesday, Jerome Powell testifies. What does that mean? We got surprised from what he said the last time he gave a public appearance versus what we saw in the Fed minutes. So whatever he says this time is likely going to really matter. Remembering that he's going to be in the top job for 4 more years. So whatever he decides to do today for policy, he's going to have to stick by and live through for the next 4 years. It's a tough ask, There's a lot of uncertainty ahead, and he needs some optionality. Right now, he doesn't have very much optionality. He's pretty much pigeonholed, again, using that word intentionally, to being dovish. He's pigeonholed. So what is he's turning a little bit more hawkish. And if you're not fighting the Fed, you better listen to what he says. We could be hearing major tones and changing movement here. So on Tuesday, he's going to be testifying and he's going to get grilled. He's also going to likely be telling us how to interpret for future data. And what's coming out on Wednesday? The Fed's favorite inflation gauge, the CPI, on a month-over-month basis, comes out on Wednesday. That could be that could be the negative catalyst after Powell. And then on Thursday, we got PPI and initial jobless claims. Cater for CPI. So if the number also comes in with a beat, that's going to be bad. And then core retail sales come in on Friday. So what does that mean? If we are seeing inflation and the retail sales are currently ticking down, that could be negative. This is a month over month. What does it mean? I think more people bought hard during Black Friday in November than they did in December. People were scared of not being able to get what they wanted, so they bought early and they bought a lot on discounts for Black Friday. So this number here might be really soft on Friday to finish off the week. We also got Lael Brainerd testifying on Thursday. She could give us some relief because she is all the way in the Dove camp, and they're testifying separately. So if Jerome Powell is going to hurt us, say from Brainerd, just something to keep in the back of our minds. You can look at that huge uptick. There's clearly some movement that's happening here. Year to date, it's one of the biggest moves we've seen on the 10-year note. So what does that mean? That's what we reviewed earlier. There's also an article here regarding China and supply chain issues from the South China Morning Post, where they're saying that, new year, same problems for global supply chains. What does that mean? Probably higher inflation, higher than that 2% that the Fed thinks we're going to get. There's also a lot that happened in China this week. We don't have time. We're not going to go through it. If you want to read it, click on the. Appreciate you. So there's some articles here I'm going to pull through. You can see what the articles are, and then I got screenshots to tell the story. So this article here, which is titled "Larry Summers Sees Fed and Market as Too Sanguine on Anti-Inflation Steps." Next one here is Jerome Powell confirmation hearing for second term set for Jan 11. Then we got one here talking about how number of stocks in the Nasdaq turns down 50% is almost at a record, which we reviewed earlier. Wall Street hails the great stock rotation, just like last. And then surging bond rates threaten to muzzle dip buying stock bulls. All right, cool. Then we got one more here. This is what's really interesting too, because it feeds into that TINA alternative. Where's my? Why can't I zoom in and out here? Okay, we'll stay zoomed in here. We'll just stay zoomed in like this so you guys can see what's going on. So inflation. TINA, what I meant is that there was no alternative to U.S. assets. However, when you look at the map here, what is yellow means they're expecting the central banks to hike. What is white, we're expecting to stay neutral or unchanged. And what is blue, we're expecting a cut. What does that mean? What is yellow is going to be bad for stocks. What is white is going to be okay. What's blue should be good. So when we think about how the European markets performed this week relative to the U.S. market, they closed green, we closed red. Why? Relative to the rate environment, the European Union looks more attractive from a value perspective, from a gains last year perspective, and from the expected monetary policy perspective. What does that mean? There's tons of alternatives to U.S. assets now, and we have to be mindful of that. Another thing that I wanted to point out regarding everything I would want to see that we're in a downturn, at least in the U.S., confirmed. All right, now we're going to go through a story from all these articles here, and I'm going to try to present faster than I did last time, but like I said, I want this to be a reference for future weeks and future months if I'm right, so we can go back and be like, oh, it is what we thought was going to happening. Again, I hope I'm wrong on all this stuff. I hope I'm wrong. I don't think I am. Officials are trying to cushion a slowdown. It's only the first week of January. They're already worried about a collapse. Oh, God. That's why their country is blue. They're looking to be accommodative. In 2022, the great decoupling that has already hit trade, finance, and technology will come to central banking. What does that mean? They're all alternatives now. There's not just Tina. There are alternatives. And as we have a look here, again, the U.S. Federal Reserve, federal Fed funds rate is currently on the upper bound of 0.2 and 0.25 by the end of this year. Expected to be at 1% by the end of next year. Expected to be at 2%. Officials penciled in 3/4 point rate increases this year in their latest forecast, while inflation declining and the jobless rate falling to around 3.5%. So that's actually a really important point. I just want to pull this up really fast here because I think that now if you look at that number there, this is what they were expecting for the end of the year. 3.5% unemployment by the end of 2022. What did we hit on Friday? 3.9 in January. Close enough to the 3.5 by the end of the year. Yes, it's close enough. What does that mean? We got the clue for liftoff. The question that remains is when liftoff will begin, not if. Let me just double check to make sure this audio is working too, because that was a really big pain in my butt. Perfect. Audio's working. Thank you, YouTube. Finally working properly for me. The question that remains is when liftoff will happen. We expect the first rate hike in the first half of 2022. When? The growth disruptions from the bad word, from Voldemort, that could occur as early as the March meeting. And the Fed has said that Voldemort is currently not derailing the recovery. What does that mean? March meeting could be live. Biden's potential nominees for filling the 3 open seats as the Fed board will unlikely change the rate outlook for 2022, though will likely tilt policies dovish in 2023. What does that mean? There's probably no change next year. 2023 is when we can dial it back a little bit more dove, get some optionality. This is Larry Summers. Again, the person who, let's actually read this quote and we'll find out who this Larry Summers guy is. Right? Like, who is this guy? Why do you keep talking about him? I've talked about Bill, someone I respect. In terms of his opinion, has he done always the best policies when he was in office? I don't know. My own view is that the Fed and the markets are still not recognizing what's likely to be necessary. The market's judgment and the Fed's judgment is that you can somehow contain this inflation without rates ever rising above 2.5% in terms of the Fed funds rate. All right. Going on here. We already reviewed this, so I'm just going to re-summarize it really fast. Again, Friday's number was strong. Why? They're looking for 3.5 by 12 months from now. We're at 3.9. Good enough. We got a 3 handle. Let's go. Let's raise. It may be, as some argue, that because of greater levels of debt, because asset prices are substantially inflated, the economy is more vulnerable than usual to rate increases or to quantitative tightening. I agree with that too. So the question is, they're going to have a very tough balance here. They're going to have a balancing act. Summers interpreted the Fed as having signaled that there is a very real and even likely possibility of kicking off its rate hikes in March. We could have a bullish surprise. So if right now we're expecting a rate hike in March, that could be the cause of a big drop. Why? The market's not currently thinking it's going to be real. They're like, oh yeah, it's real. And if over the last 10 years you've been rewarded for buying the dips, why not let you buy the dip a few more times before they pull the rug out? The challenge for the Fed is that they're likely to see some amount of fluctuation in financial markets. What's a financial market? The stock market. And concern about growth before they see the declines in inflation that are substantial. What does that mean? Inflation's really high right now. And they're going to have to break the stock market and have some concerns about growth to really get inflation in line. So we're going to have to see to this policy, and they're really going to get tested. We're heading into a very challenging period for the Fed in terms of executing on a soft landing. A soft landing is a nice idea. As of right now, it is a thesis. It was not soft in 2018. Jerome's trying something different, but this is a new time. There's never been a time like this before in history. All right, so who is Larry Summers? Lawrence Summers, former U.S. Treasury Secretary. All right, when? Oh, he was the 71st U.S. Treasury Secretary between 1990 partying like it's 1999, and he was the guy in charge of the printer when the dot-com boom and bust happened. This guy's opinion matters. Why? He's saying what he thinks. He used to be Janet Yellen right now, by the way. He's also a Democrat. What does that mean? He's not trying to talk shit. He is a Democrat. Oh, he is. Oh, never knew that. Yeah, he's a Democrat. So it's important for us to note that. Why? This guy's saying what he thinks the US needs to be stable and to remain the superpower. He's not trying to hurt people's feelings. Powell's going to be testifying on Jan 11th at 11 a.m. That is Tuesday. What does that mean? Jerome is probably going to have to make sure that he actually delivers what the market needs, not what the market wants. The market wants more sugar. It's currently experiencing a hangover, and now we might go into a full-blown, right? We don't know what's going on here. Sell first, ask questions later. So I think part of the problem here too is that people don't quite believe it because they saw this movie before too. They saw it last year. The recency bias. Yeah. 21 too. But here we are, right? Wall Street hails the great stock rotation just like last year. Market moves are unfolding as they did in 2021 before fading. What does that mean? People are probably still expecting we're going to see the fade of the current trends where we get temporary dips and then it fully reverses and makes new all-time highs. Why? That's the narrative out there. That's what everyone's talking about. And last weekend, what we noted is that the biggest disconnect between analyst price targets for the S&P, the biggest time they missed and there was a disconnect was in 2018. Again, that stupid 2018 keeps coming up. But this time, I have to make sure I lube my throat because I've been talking for 2 hours and it's getting harsh. But this time, confidence is growing that the rotation is here to stay. Stock hedge funds have upped their value exposure to the highest in at least 4 years. Oh, geez. And all banks are joining Morgan Stanley, Wells Fargo, and more in touting equities that outperform when rates rise. Ah, crap. What are those? It's like financials, it's like energy, it's like farm. Yep. This is from last weekend. Play defensive has replaced fear of missing out as the market's mantra. And again, if we look here, pricing power, firms with stable profit margins are outperforming in the fourth quarter with continuation in a big start to 2021. What does that mean? Build up your position, jack it up, make it worth money. People are accelerating on the trend. They're hopping on the bandwagon. We talked about this. So, right, this is the pressure we're going to be seeing. Again, seemingly, what did I do? Seemingly overnight, it is beginning to appear as if there are ample opportunities and alternatives by year end. Oh, crap. You can go buy Europe. You can go buy China. You can go buy value stocks. You can raise cash. There's a whole bunch of things you can do. Just buying and holding US equities, notably tech or growth, is probably not going to work. All right, moving forward. That one too. Been 2 months after October, which is what everyone's talking about right now, right? Oh, crap. Yep, 10% down in December of 2018. Charts show me the evidence. We talked about this too. Outflows out of QQQ. So there's money flooding the system right now. Where did it go? It didn't go into QQQ. So earnings season when they kick off is going to really matter. Apple's the big dog. So like when Snapchat reported earnings, it set the tone for a lot of names to start moving lower. And then DocuSign just absolutely stomped 45% decline after earnings. I've never seen a decline like that before. And then other ones did it too. It was just the first. It wasn't the last. It's not a one-day rotation. This is the beginning of a potential 6 to 12-month rotation. Yikes. That's why hedge funds have been loading up on cheap shares, right? Quants have raised their value bet to the highest in months too. The Fed wants higher real yields and has the tools to make that happen. So investors should position for that outcome. What does that mean? Fight. They're telling you what they want. They're unwinding 2 years of easy monetary policy. And there will be a hangover. The sugar rush has been good. It's been fun, but our teeth are getting rotten. It's time to brush our teeth and go back to normal. So again, what we reviewed at the very beginning of the video here now, we're going to reread it and see if it makes more sense. And again, please smash a thumbs up and please drop a comment at some point if you're enjoying this video. I've worked incredibly hard to get this out. I feel like I've put in as much value as any video I've done before, and I really think I'm right here. I hope I'm wrong. The fundamentals and macro considerations, there is no doubt that investors have been selling first and trying to figure the rest out later. I did exactly that, as I mentioned. I liquidated my portfolio this week on Tuesday and then on Thursday. It felt great. I couldn't quite put my finger on what exactly was the reason why, but in hindsight, as I do my weekend deep dive, my spidey senses were tingling. I've been through downturns before, and my gut just knew, hop out. If in doubt, hop out. I hopped out. Another way of thinking about tech wreck, at no point since the bursting of the dot-com bubble have so many companies fallen like this while the index itself was so close to a peak. And what is Jim Cramer saying? Fill up some bids. I got to stomp them. I got to get those bids filled. I got to get out. So Larry Summers been right so far, talking about how if we don't do something now, we're going to have to course correct even harder. What happened in the 2000s? The exact same thing. He wasn't just talking about it. He was the guy in charge. He is the Janet Yellen of 1999 to 2001. All right, moving forward. Valuations are historic highs. Companies are raising billions on fairy dust, pixie dust, and the Fed is signaling a tightening cycle. All of these are scaring investors that were on the cusp of a repeat of 1999 to 2000. It could become a self-fulfilling prophecy. We're looking at 2018. We're looking at 2000. This is not pretty. All right. I think I'm doing a little bit better for time. Going forward now, we're going to look at the ETFs. Then we're going to look at the options. Then we're going to have a look at SPY. I've already gone through peak cycle, peak Voldemort. We're going to skip that because YouTube doesn't like it at all. Just know that I did take that into consideration in doing this video. I think that March is when we're going to peak out. So if the Fed is already telling us that, and this is what matters, right? Don't fight the Fed. The Fed said that Voldemort is not impacting the economic recovery. What does that mean? If during peak winter, when we locked down in 2020, meaning late February and early March, they're saying that it's not going to impact us and we have to hike. If everything goes hunky-dory and the world reopens in March or April, when everything starts to get peak feared, and then we go back into the spring when flu season ends, summertime happens, sun comes out, they're going to claim victory over Voldemort, right? Voldemort's gone. Don't say his name again. And that's literally when we should be confirming acceleration of normalization. Why? We've been printing like you would believe. So what does that mean? They should be hiking in March. Oh, really? Yeah. So looking here too, fear and greed index also tells me that people don't know what's going on. Why? They're right at neutral, right at peak complacency. Why? It appears they're at an area to buy the dip, but people seem apprehensive. Why? I understand why. So we went from greed to fear. Sorry, went from fear to greed in 1 week. From 1 month ago, we were fearful. 1 week ago, we're greedy. Now we're back to neutral. What does that mean? You're sufficiently confused. Don't know what's going on. Rotation is clearly underway into names that have holding power, pricing power, and are currently cheap. Compared to what happened in the last 3 months, there's All right. Here's where I'm going to start going through the charts. The QQQ, which we talked about before, which saw that $700 million in outflows. We're going to look at it here. And what we have to keep in mind too is that before we can go down, which is what a downturn is, we have to stop going up. We go up, we stop going up, which is sideways, and then we have the potential to go down. So as of right now, all it is potential. So the notes here say that we are still trending up, but at risk of a break, losing 368. Confirmed this week, but line in the sand for me. What does that mean? If we lose this previous top, I think we're going to test the 50 EMA, and that could be the start of the drop. Technically, for right now, we're still going up, which means as of right now, it's an early warning signal. We're not actually going down. We're starting to go sideways with a clue of more downside. When I look at this next chart here, though, here is where I get my butthole percolated. It's tightening up. I'm getting a little bit apprehensive. Why? Well, I'm seeing the exact same technical setup I see in 2018. This is a log chart. The reason why I'm doing that is to make sure that the lines are not exaggerated for the most recent moves. When we look at the arithmetic scale, it's a lot harder to see the emphasized moves. We look at the log scale, it's easy to see. I hate to say it, but it's looking a lot like late 2018 here as rates start rising, which is what? When Jerome Powell was at the Fed raising rates, it looks exactly the same. Also had a period of like pretty much uninterrupted growth. And then we start what? We put in, let's just look really close here. So we look at the box, right? All the way up, start going flat, double top, one nasty stomp right down to the 50, dead cat bounce, and then down to roughly the 200. Uninterrupted advance for 2 years, right? Big nasty cut. Crap. That 200 MA is way, way, way down. It's way, way, way down. So at prior, and same thing here, right, in 2020. So 2018, 2020, 2022. So, right, there we go. Drop, hit the 50, dead cat bounce, roughly test the 200. If we go to the 50, we're probably going to the 200 based on what I'm seeing so far. So again, actually hitting the 50, dead cat bounce, usually dances, then hits the 200. Looking at 2018 specifically, if we compare that here to 2022, the 50 MA is at 356 and the 200 MA is at 244. So losing that 368 from the previous chart means that we're likely going to test that yellow line. If we lose that on a dead cat bounce and retest, we fall back below it. We're probably going to go somewhere into low 300s, high 200s, maybe mid 200s. I don't know. The numbers are really low, though. I recognize that too. Looking at the percents here too now. So again, thinking about math. In 2018, we went down by 20%, peak to trough. In 2020, we went down 30% from peak to trough. And where do we go? To the 50 weekly moving average, dead cat bounce, then down to roughly the 200. In 2018, we did it. In 2020, we did it. And now in 2022, if we're going to repeat, does the math also make sense? Answer is yes. The 200 MA for the monthly, so the 200 MMA is currently at 40% decline from where we are now. 20% in 2018, 30% in 2020, 40% in 2022. Why? The problems from 2020, 2020, 2018 have not gone anywhere. They've been compounding. So what are the numbers? Okay, now moving beyond tech, we're going to look at financials. And we're going to look at everything else. So XLF, I said it last weekend. If XLF breaks out, it likely means that the market thinks rate hikes are real. What do we got here? We got a bullish break like you wouldn't believe. That's what I was expecting on the monthly chart for SPY. Gap and go. Didn't happen. So XLF here, record high, new all-time high close. Bullish. XLV, if we are hitting peak Voldemort, is this not what it would look like? Big nasty cut. Yep. Still trending up though, right? None of these are trending down yet. So all of them are trending up still. We're still actually going up. So it's scary. DIA, fat cell bars. They are getting smaller though. Compared to the green bars, they are notable. Just look at those size of the red bars, right? They're pretty big relative to the green ones. More cushion if we do fade. IWM, already complete trash. It looks ugly. Why? It's gone nowhere for a year. Pushing off the 50. That does not look nice. NYSE. How did it close green? It closed up by 1 basis point or 0.01% or 2 points. Why? Value. We're seeing rotation. It looks impressive. It closed flat. It looks a lot like DIA. Why? There's no tech in there. It's not tech weighted. It's not tech heavy, sorry. There are tech stocks in the NYSE, just not very many. RSP or equal weight SPY. Looks similar too. Why? It's equal weight. It's not tech weighted. So what does that mean? It looks stronger. As expected. Why? Less beta. What do we got next here? We got EEM, so emerging markets. So looking at the rate outlook for the global map, where rates are going to rise in the US and in North America and be accommodative in Asia. Emerging markets look attractive here. I don't think it looks attractive. I'm just saying it closed green and barely. There is a funnel down to the 200 DMA, which likely just means that if the world's going to tank, emerging markets will tank less fast. Gold, relative to crypto, not all that bad of a week. Up for 3 weeks in a row, back down to the 50 weekly moving average. IHS is still intact. It's doing a whole bunch of sideways action. So the break is going to come and we'll get our true move. As of right now, it just looks uncertain, right? really, really, really range bound, which means the coil is springing up and it's going to release one way. Which way? I'm not sure. I think it's going to be up. BTC, we talked about it before. We're bear breaking. So we've penetrated below 41,000. I don't know where we are right now. We were at 40, like 4,600 last time I checked. This is delayed data, which means we've already punched below there. But if by the end of the month we are below 41,000, that downturn is being respected and we're likely going for more downside. Finally, Arkk, Psych Chart 101. Talked about this before. Don't need to spend more time on it. Nasty rejection off the previous low, right? Dead cat bounce, fresh cut. All right. Options. So everything so far tells me that we should be worried. So again, I don't like telling a story where I'm telling you that because I know what happens if I'm telling you that the stock market could drop by right as much as 40% for the Nasdaq. I know what that means. It means the world is going to be going into a darker place it is today. I don't like saying it. I also don't want to be caught off guard. So I'd rather warn you now, even if I look stupid for saying I think we're going to don't. Why? I'd rather be expecting the best, prepared for the worst, and understanding what the surprise could be before it happens. Why? When you get surprised, you usually don't know what to do. So if you're hearing the story now, when it plays out later, you're going to be like, I don't want to believe it, but I've heard this before. Maybe I should believe it. Maybe I should even just de-risk a little bit. Why? Buy back a little bit higher if that's what it's going to be. So everything we've looked at so far supports my thesis. Everything. I would love to be wrong. If you see a hole in my story, please drop a comment. I would be thrilled this week. Tell me what I'm missing. So looking here at the options chains now for more evidence, Monday is notably bearish. There's almost nothing in call volume. We got one strike at 470. Otherwise, it's all about puts. And the premium attached is huge. We also even have a put open interest at 465 and 458. Why? They thought we were going to go down even before Friday. They're like, yeah, got to get those puts, baby. Got to get those puts. And they got them. Looking at Wednesday, it's muted. So what I noted last weekend was that the chain was fairly muted for we got a big nasty surprise, which meant that we weren't properly positioned for the move down, and it punched down hard. I don't see anyone really positioned here for Wednesday, which is going to be the day after Powell and when we get CPI. Just like with the Fed minutes last time, no one was really positioned. So I think there's a chance for a nasty surprise here. Everyone's just a little bit too sanguine, a little bit too complacent, like Larry Summers said. Why? For 10 years, you've been rewarded for buying the dip. So what do? If you don't want to short it, you wait for the dip, buy the dip, you make money. You don't bet against the market. That's been the story for the last 10 years. Looking at the Friday, now the bears are they're flexing here. It's noticeably bearish. We got big put interest at 460. We got volume at the money at 467 down to 465. We got the same naked buying at 470 for the calls. There's not a single strike that's above 10K for open interest though. What does that mean? If this is the dip to buy, no one's like I want to put my money behind it. They're like I don't trust it. I don't know. They should be getting cheese for Friday if we're really going to be resuming back up. They're not. So what do we have instead? We got puts everywhere. Looking out to January monthly now, what I note is fat stacks all the way down to 400 puts and lower. What does that mean? These bears are hungry. And I think the bulls can stave them off again one more time until they get those big tech earnings. Then we actually get the confirmation we're going to be moving down. February is pretty naked. VIX is pretty jacked up right now at about 20, which means buying long dated puts is just too expensive. So they've piled in head first into January. They can burn it by Jan 21. And then Apple and big tech start kicking off almost 1 week after, which means post Jan 21, they can start positioning for the bear side, buying up what they want, and then let it actually go the right way. If we do start moving down, though, I'm telling you, there is put open interest all the way down to 400 and lower, which is hard to ignore. On the call side, we got 480, 485, and naked call buying at 500. I'd also note here that we got a straddle here at 460, which means that that's where the biggest open interest is for both. Also a volume here on the put side, which looks like a put spread. But when we take 460 and we take the 9.5 in premium plus the 3.3 in premium, we get roughly 12.8 points. and then we subtract 460, which tells us the break even for the put side. That's at 447. We're going to look at, I'm re-recording this, so I forgot that we're going to look at the SPY charts a little bit later. That 448 area is really, really important too. Why? 447 would be a monthly lower low. I already know that. So if these puts are going to pay out on the straddle side for, if the straddle is going to pay out on the put side, meaning they're going to pay out the put side of the spread of the straddle, we got to be at 447 for them to get their money back. I think they're going to want to make some money, which means lower. And if we now take that and we go that's 460, 472. So on the upside, we're looking for about 470. On the downside, we're looking for about 447. 473.50 is a really important top too. Remember that, right? That's the previous Jerome Powell top, double top. Looking out here to, so note here, this expires, this expiry is roughly 1 week before big tech earnings kicks off, which means I think they're going to hold the bears back. We're going to dive down, but they're going to hold the bears back. They're going to artificially move it back up and then let it fade. That's what I think. Into February, new monthly lower low into February. Confirmation we're going into a downturn. Looking out here to QQQ for next week, we got 385, 375 put spread. Sorry, 380, 375 put spread. Wednesday's muted. I'm going to go through it faster. It looks just like SPY. So a little bit of calls, more puts. Wednesday, very muted, which means people are going to be caught with their pants down. I have a strong feeling. Into Friday, bears down to 375. So we got puts all the way down here to 375. There's a strategy too. Looks just like SPY. Naked call buying at 385. Very, very, very muted. And then going out to Jan monthly, what I note here is that it doesn't even look like there's a straddle. They're just like puts. That's all we want. Puts, puts, puts. So when I look here, what's notable too is that 380 to 375 is numbers playing through on all the chains. So we're seeing activity into Monday, continuation into Friday, and then continuation into Friday the 21st, 2 weeks from now. And same strikes, notably notable activity. And when we look here, the reason why this 380, 375 is notable is because that's roughly the same 50K and roughly the same volume at about 15 and 20K. What does that mean? It looks like there's someone executing a certain type of strategy here. So that is it. We're at 52 minutes. I got to start wrapping up. Last thing to go through is going to be the SPY charts. And with everything we've already reviewed, remember the levels. These should be very important. You should now understand what I'm trying to show. So looking at the monthly chart now, what I thought was we were going to be getting a move higher. We started the month off with a gap up. We printed a higher high, slightly higher high, like 1 point, and now we're back to red, notably red. We're down by 887 or 187%. So as of right now, we're invalidating this pattern because we don't have that move. We don't have that move here. And using our Fibonacci extension from that same period, what's important is that we're closing almost perfectly on the 423% extension. What does that mean? The dotted line. We're almost perfectly on it. So tested it once, tested it twice. As we look here, 459, 452 are very important areas. Roughly 449 would be a monthly higher low. So if we print below 449, that is an engulfing candle. We are engulfing the whole previous candle. We'd have a higher high, we'd have a higher low, and we would be setting up continuation. What does that mean? Hold on to your butt. Looking at the weekly chart, 459 wants a test. Bad. If I remove SPY from this chart and I said, what do you think it's going to do? I would say it wants 459. That's what I would say. It wants 459 in a hurry. 454 would be strong support below that. And then a weekly close below 454, like a weekly close below 368 on QQQ, sets up a push to the 430s. Strong support at 436. Looking out here to the daily chart. So we don't see a downtrend yet. That's what's really important. As we go to shorter time frames, we see the potential for a trend change. But as of right now, we're still trending up. On the daily chart here, technically still trending up. Starting to go sideways though. Why? Well, again, we're starting to do this. Also important to note that if we lose the 462, which was serving as a W here, now it looks more like a head and shoulders with a head, shoulder, shoulder, where we can see that the green arrow points to this relative low here at 462. And if we lose that, we're already showing the same signs as we saw on QQQ. Power dump down to the 50, indecision, high, lower low, closing near the low of the day, closing below the 50. That is not a recipe for a bounce. Losing 462 on a closing basis means we're cracking, and 445 would be key support below that, coming all the way back down to here. So again, 440 seem not just probable, seems likely. All right. Now going down to the hourly chart. So the hourly chart is already giving us a downtrend, and I think that if we just lose this neck, we're confirming we're actually trending down, and volume will pick up. So looking here, what's important is the 466 key pivot, which was our 4% extension on the monthly, and then also going back to here, it's a key pivot. So I would note that if we ride the downtrend we're currently in, meaning this white line here, we keep riding down this white trend line. We're going to be at 462 into Powell on Tuesday at lunch. We're going to be at 461 into Tuesday close, and CPI is going to be coming out pre-market the next day. We're going to be at 456 into Thursday noon, which is when Brainerd's going to be talking, and then 452 into Friday noon after retail sales, which means if we're above any of these numbers by the date, it means we're breaking the downtrend on the hourly chart. So with that said, I know I might have scared a few people. So what I want to make sure of is that you understand the potential for where we could go. I'm not saying for sure we're going to be going down, but this man is going to be in focus. And I think that we have to be aware of the potential for up, down, or flat. As of right now, I would rather the bulls prove to me that we're going back up than to try to catch the knife. I don't want to be the person caught. And I hope you've got a lot of value from this video. If you did, please smash a thumbs up. Please drop a comment. And if you want to have more coverage, come back and join us on our other channel, Blaze Capital, for daily coverage for the stock market open from Monday to Friday. Thank you very much for watching. I wish you all the best of luck for the next week. And thank you again for supporting our channel. All the best.